Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two co-hosts, Chris Derides and Marissa Di Natale. Hi, guys.
Hi, Mark.
Mark.
Good morning.
So it's been a pretty eventful 24 hours or 36 hours.
Yeah,
You laugh.
it's
You
been a
laugh.
pretty unproductive 24 to
unproductive.
36 hours.
Right. I mean, this is Saturday morning. Typically, we record the podcast on Friday, and the delay was because of the CrowdStrike patch, which really kind of messed things up for us. So it's still scrambling to get it together, but here we are. And Marissa, you're still not even on your computer.
Right. I mean, everything was fine yesterday, and now today I can't get on.
Wow.
So
And you're on your phone, and that's why you sound a little
I'm on my
bit,
phone.
so
Yep.
everyone knows, a little hollow, but
Mm-hmm.
you're not your normal, boisterous.
Not in spirit,
robust,
though.
not in spirit. Well, very good. You've weathered the storm better than I would have. I would have been losing my mind if I lost my PC. Anyway, and Chris, you kind of sailed through this no problem?
I wouldn't say no problem. We had
Okay.
trouble getting on our websites and whatnot, but my computer never had a problem. I never had a problem logging in.
So bizarre. So bizarre.
Yeah, it's kind of random, a bit random.
Yeah.
And
we
other
got a
companies
guest.
are doing just fine.
Pardon me?
Other companies, other banks, I hear are doing just fine.
Even though they have CrowdStrike as their cyber software?
Well, that I don't know all the details, but it seems like it's
because I think we have CrowdStrike. I think
yeah,
part of our cybersecurity.
Obviously.
Yeah, obviously. Right. I'm not saying anything that's not known. So. All right. And we have a guest, Gus Faucher. Hey, Gus.
Hey, Mark. Good to be talking with you and Marissa and Chris.
Yeah, it's been a long time.
It has been a while.
And where are you hailing from? Are you hailing from Pittsburgh?
I am in Pittsburgh, so I am the chief economist at PNC Bank. As you know, I left Moody's Analytics back at the end of 2011. So I've been with PNC for a dozen years now. Been chief economist for about 7 years. And in fact, this is a big weekend in Pittsburgh because the Phillies are playing the Pirates this weekend. And so my dad came into town. He and I went to the game last night, and then we're going to go to the game again tonight. So unfortunately, the Pirates came back and won it in the bottom of the ninth. So we were disappointed by that. But it was a fun crowd, and it's always good when the Phillies come into town.
Let me get my mind around that. So you've been living in Pittsburgh for 12 years and you're still a Phillies fan. Is that what you're saying?
I grew up in the Philadelphia area. My dad still lives in Philadelphia. I've been a Phillies fan all my life. So, I'm still rooting for the Phillies. Yeah.
Oh, that's good. Because it's called PNC Bank Park. I'm pretty
PNC
sure.
Park, yeah. And it is I will tell you, it is an absolutely gorgeous stadium. It overlooks the river. You can see downtown across the river from the stadium. It's a fantastic place. So if you're ever in Pittsburgh, I'll take you out to a game.
Absolutely.
Just has the wrong team, right?
The Pirates are fun. I like watching the Pirates. They have some good young players, but no, I'm a Phillies fan at heart.
Well, I'm a fair weather fan, and I was watching a little bit of the game yesterday. Disappointing ending, I'd have to say, as you pointed out. But there's a lot of red shirts, meaning Phillies fans in the crowd. You were probably one of them. You were one of them.
I was one of them. My dad was one of them. I would say it was probably, at least where we were sitting, it was more than 50% Phillies fans there.
Oh, is that right? Wow.
Yeah, but they did have a sellout, and should be another big crowd tonight.
Yeah. Well, it's good to have you on board. And I can't believe it's been a dozen years since you were at Moody's Analytics. My God.
Yeah, no, it's that was a great experience, and it's been fantastic working at PNC, and we've really enjoyed Pittsburgh, and it's been a great place for us and for Amy and for the kids, and it's worked out very well.
That's great. Yeah. Well, I love PNC Bank. Did I ever tell you the story about PNC Bank when the company I started with a good friend and my brother, Carl, back in 1990, we needed our first business loan. And so my instinct was to go knock on the bank where I had my deposits, and that was PNC. And so I knock on the door and I say, of course, there was like, I don't know, 5 of us at the time working at the company, the predecessor company. It was called Regional Financial Associates. And so I go in there, knock on the door, say, basically, I need a line of credit. I want to go hire people. And they said no. They said no. So I had to go to Malvern Federal Savings Bank, which is, 3 branches. And the only reason why I got a loan was because the bank president's daughter was on my daughter's soccer team and I was the coach. So of course I had to sign over my home and everything else I owned, which was basically my home. I don't even know how much equity, but PNC turned me down, Gus. I don't know what that's all about.
I'm sorry to hear that,
that,
Mark,
Gus.
but that was before I started, so
Yeah,
I can't
that's
be held
true.
responsible.
That's prudent risk management.
Yeah, absolutely. They would have been nuts to give me a loan. They would have been nuts to give me a loan, but it all worked out. In the end. But it's so good to see you and glad to have you aboard. Okay, so how you feeling, Gus? How are things going out there?
So I think things look pretty good. I think that we are headed for a soft landing. I think that on the inflation front, we've started to get some better news, particularly on the shelter side. So we've been expecting that to happen. With given what's going on with measured rents, we expected to see a slowing in shelter inflation, and so that we kind of stalled in early 2024. But the last couple of months have looked a little bit better there. So I think that we're moving towards the 2% objective, and so I think we're looking good from that perspective. And then also we're seeing a little bit slower wage growth, right? So job growth has cooled off somewhat. We've seen, wage growth slow to around 4% year over year, still a little higher than I think what the Fed wants to see, but certainly much better than when we saw wages increasing 6% year over year a couple of years ago. So I'm feeling good on that side. And then in terms of economic growth, I think things still look pretty good there. We're seeing a little bit slower growth, but that's probably a good thing because we want to see growth slow towards potential, which is, probably somewhere around 1.8%, 2% a year. I think consumers are holding up well. I think that with the solid job growth and with real wage gains, wages running ahead of inflation, I think that consumers are able to increase their spending. I think we will need to see a bit slower consumer spending growth. I think we need to see the savings rate come up. So we need to see spending growth that's running below income growth. But I think that we can achieve that, see the savings rate come up a little bit. And that should allow for a bit slower economic growth. I think business investment looks pretty solid still. I think that, we'll get a little bit of a boost from lower interest rates, and we can talk about that in a few minutes when we talk about the outlook for the Fed. And then the housing market, which had been a drag on growth in 2022, first half of 2023, it's not like it's adding to growth, but it's not subtracting from growth anymore. So, I think that, and to be honest with you, and I know that you guys were in a different place, but a year and a half ago, when the yield curve inverted, we thought we were going to get a recession. And so we put a recession into our baseline forecast. Obviously, that did not play out. And I think the strength of the consumer was the primary reason that didn't happen. But I think things look good right now. And we're expecting to see slower growth this year, first half of next year. But I think that's very welcome. And I think that we should be able to get back to 2% inflation by roughly this time next year.
So you use the word soft landing, and that's kind of the way that's the phrase economists use to describe an economy that is going to settle in at a slower pace of growth, but at a pace that's consistent with full employment and inflation back at the Fed's target. Would you characterize the current situation as a soft landing? Have we soft landed, or are we still not quite there yet?
I don't think we're there yet. I think we have to get to that 2% inflation before we can successfully say that we've had a soft landing. And it's easy to see how things could go wrong on that front, right? And not that I'm saying this is going to happen, but if we have a conflict in the Middle East that pushes up energy prices again, and then the Fed needs to tighten further and consumers cut back because they're spending more on gasoline. We've gotten some deflationary help on the goods side. And so that certainly has been a positive, but we do have, the issues in the Red Sea. Perhaps we see that goods inflation picks back up again. And so that makes it more difficult to get to 2%. So I don't think until we see, I don't know if I don't know whether we need to see inflation hit 2% year over year, if we need to see 6 months of annualized 2% inflation to say soft landing. I think we're headed towards a soft landing, but until we get, consistent 2% inflation, I would not want to say that we're there yet.
What about you, Chris? Would you characterize, are we in a soft, have we soft landed, or, what's the thing that would be enough to say, hey, let's declare victory, we've soft landed? What would it be?
Yeah, I'd say primarily inflation, right? You need to get that very, very clear signal there. But I guess I'd go a little bit further and say I even want some of the financial markets to normalize, like the yield curve. I'd say that should be positively sloped to really say, okay, we made it through this entire cycle and things have normalized completely. Right. Otherwise, we're still at risk in my mind.
At risk, right? Marissa, what about you? What are you?
I'm a little bit more forgiving, I think, on that. I feel like I'm kind of there already in my mind on it. I mean, the labor market has been great for a long time now. So I think the Fed has achieved its full employment mandate a while ago. I don't think they have to worry about that. Now I think they have to worry about the labor market slowing too much. And I think on the inflation front, yes, we're not at 2%, but that's really at this point almost a technicality because of shelter inflation. And I think all know that if you take that portion out, right, if you take OER out, we are at or below the 2% target and have been there.
Owner's equivalent rent, right?
Right. And in terms of things like these markers like the yield curve or consumer confidence, I just think these things are sending false signals at this point. And I'm not really worried that at this point any of those things are calling for recession, because they've been in the territory that they've been in for a very long time without a recession. So I feel good about the economy. Of course, there's risk. There's always risk. And yes, it's more heightened right now, but I don't know. I'm not sitting here waiting to see if there's going to be a recession at this point. Like, I feel like we've mastered that.
We've made it.
But I guess I'm a little more, and you raised a good point about the shelter component in inflation. But, the Fed by their own lights has set that 2% objective using the core PCE price index. And so I think from their perspective, I'm not sure that they would call it a soft landing until they actually get there.
Yeah. Well, who cares what they think? Yeah.
You asked what I
like who cares what I'm asking you and Chris and Marissa. That's what I care about. I don't care.
Fair enough.
I mean, Gus, I think you're totally right. I mean, that's why they haven't lowered interest rates yet, because they are tethered to this 2% target, and they have said that again and again and again, and it would risk their own credibility to start lowering rates before they're clearly, I don't think they want it. I don't think they necessarily need to be there, but they need to be very close to there and heading toward there very definitively. So I understand what they're doing, but I think if we're talking about where is the economy in the business cycle, I think we can almost say we've made it to a soft landing.
Yeah, I think the key is, for me, the Fed actually cutting rates. Until they cut rates, it's hard to conclude that you soft landed, because they can still make a pretty serious mistake here, keep rates too high for too long and do some damage. And, so as soon as they start cutting rates for the right reasons, not because the economy is falling apart, but because, they feel comfortable that inflation is going to target, they've achieved their mandate for full employment, and they're good with things. I think at that point I would declare soft landing. So hopefully that's coming up here pretty soon. One other thing before we move to Fed policy, monetary policy, Gus, you did mention that you were calling for a recession that didn't materialize, which was, the widespread expectation. I'm just going to brag. We did not call for a recession. But I'm curious, what was it that you were looking at that made you conclude that recession was more than likely, and that was your baseline forecast? What was it?
I mean, it was the tightening in monetary policy and the big increase that we had seen in both short-term and long-term rates, starting long-term rates started to go up at the end of 2021, but then throughout 2022 and into 2023. And, we were looking at the yield curve, and the yield curve has been a very reliable indicator. It's not just my forecast, it's a forecast that we put together with other people in PNC. And, some people are saying, well, there's no way.
See how he does that? It's not me to blame. It's like, it's the committee.
It's my name that's on the forecast, Mark. I mean, I get the credit if things are right.
I'm only teasing you. Of course, I'm only teasing you. You know that. Yeah.
But anyway, so and so we had people saying, well, there's going to be a recession. There's going to be a recession. And I wanted to see something more. But when we did start to get that yield curve inversion, kind of in the second half of 2022, I mean, that's been a very reliable indicator, as we all know. And I don't want to say probably, I did put too much stock in that. And assume that when we got that inversion in the yield curve that we would get the recession like we almost always do. But I think that it's just, as Marissa pointed out, it's just not as good an indicator now for lots of different reasons coming out of the pandemic. And maybe it'll return to being a good indicator once things really normalize. But I miss that, and in fact, I write a newspaper column for the local paper, and I did a whole column on how I got it wrong and why I got it wrong. So I'm happy to take the blame for that one.
Yeah, the yield curve is the difference between long-term interest rates and short rates, and generally it's so-called positively sloped. Long rates are higher than short rates, but every so often it so-called inverts. Short rates, because of Fed policy, rise above long-term rates. That inversion historically has been highly correlated with recession down the road. And I can see why from the prism of a bank, like a PNC bank, the yield curve feels very compelling as a kind of a predictor of future economic conditions, because when the yield curve inverts, that makes life very difficult for a financial institution, a bank, right? Because they tend to borrow money short at short-term rates and lend long, and they make money on that so-called maturity transformation. So when the curve inverts, you can't do that. There's no way to make that money, or it's harder to make money on that maturity transformation. You pull back on the availability of credit, and that is a catalyst for slower economic growth and ultimately recession. That's me talking. Does that sound right to you? What I just described? Okay. Is that the intuition behind why you think the yield curve is a good predictor, or at least historically has been a good predictor of future recession?
If we think about what determines long-term yields, it's inflation expectations, long-term inflation expectations, and then expectations for longer-term growth. And the expectation was that growth would weaken, turn negative. The expectation is that inflation would slow. And, the slowing in inflation that we've seen over the past couple of years without a recession is really unprecedented. Now, there are reasons why that's happened, the pandemic dislocations, the supply chain disruptions, all that kind of stuff. But I think the view is that the only way we can get from, and I think core PCE inflation was 6% or something like that. The only way, the way to get from 6% inflation to 2% inflation is through a recession that kind of, that reduces demand. And so I think that, that was a factor behind the long end of the curve being lower, that inflation was going to get to 2%, but only through a recession. So, looking at it from that perspective, that was the view. And that's why we decided to put the recession into the forecast.
So why was it wrong? Why was the curve wrong? Why do you?
Because,
by the way, the curve is still inverted. So if
yes,
it's been inverted now a long time, and maybe as long as it's ever been by some measures, probably.
Right, and it's not just a little inverted; it's a lot inverted.
It's a lot inverted, right?
Yeah. I think there were a few things. I think that at least Some of the inflation turned out to be transitory, like Powell was initially saying. I think on the goods side that, as I mentioned, we're actually seeing core goods deflation. Those prices are down, but, the surge in goods inflation that we saw in 2021, was due to the supply chain disruptions, but then goods demand stabilized, supply chains were rebuilt, and so that dissipated. Marissa talked about the shelter component, and that may not be a reflection of actual inflation. And so hold on, I'm trying to think through the thing here. And then I think that the consumer balance sheets, the excess savings that we've been talking about, the fact that they had those stimulus payments saved up. I think that meant that even when rates went higher, consumers didn't pull back on their spending as much. And then there's a lot of pent-up demand on the services side for consumers. So, we've seen goods spending roughly flat over the last 2 or 3 years, but services spending has continued to increase pretty strongly. And so I think that consumers still had some of that stimulus money saved up, and so they were using that to spend on services. And so consumers held up better than might have been expected, given the big increases in rates that we've seen.
Okay. Hey, Chris, how do you, and by the way, I should just mention on a previous podcast, we had Campbell Harvey, the Duke professor who popularized in his PhD thesis the relationship between an inverted curve and recession. And I think it was Chris, correct me if I'm wrong, I thought that was a pretty good podcast. Although, and he ended up saying, the yield curve, as I recall, he said, don't worry, the yield curve inversion isn't going to result in recession. This is the first time that this predictor isn't going to work. And then he backed away after the podcast, didn't he? He kind of reversed himself and got obviously wrong. I mean, at least so far, it didn't turn out the way he expected. But Chris, why do you think the yield curve hasn't been as reliable, or has not been a good predictor of recession this go around? What happened there?
Well, I think Gus identifies many of the reasons.
I have to tell you, they're not satisfying explanations.
They're not satisfying to you?
No.
Okay, I'll give you another one.
The yield curve knows all that. Everything you just said, the yield curve knows that, right? The investors know that. That's embedded in the yield curve. So why and historically, they always get that stuff right. I mean, the collective wisdom of the yield curve, which means bond investors get it right. So what happened this go around that is different? Why didn't they process the information properly?
I'll give you another one. Another reason that's going to be unsatisfactory to you.
Right.
I think to some extent we got lucky. Right.
Lucky. Now I like this. Okay, go ahead.
We were vulnerable in that inverted yield curve. I think we still are.
Yeah.
We got hit by several shocks that I think also led to the conclusion, the probability of recession is really high. Right. We had a banking crisis. We got very close to a debt ceiling crisis. And on top of of course, the supply chain disruptions from the pandemic, the oil energy crisis or energy disruptions from the Russian invasion of Ukraine. So either was luck, or if you want to be more generous, the skill of policymakers adeptly adjusting to some of these shocks. I think that, I think that's one of the reasons why perhaps the yield curve wasn't as predictive this time. Investors didn't believe that we could make it through with all these shocks. In a very graceful way that a recession would have been.
Marissa, do you
high
have
probability event?
Do you have an explanation? Hopefully, it's better than these other two guys.
Well, I mean, there is. Some people believe that the Fed was kind of artificially pushing more, the long end of the curve lower because they were buying so much mortgage-backed securities and longer dated treasuries. So.
The quantitative,
through quantitative
argument,
easing.
Which is a reasonable argument. It's got to be at least part of the story.
I mean, we haven't had that in past cycles. That's a relatively new tool. So in previous business cycles, you didn't have that phenomenon. So, I mean, that could be part of it. Could be part of why the long end of the curve is lower than it otherwise would be.
Right.
And then we also believe that.
Sorry, Marissa. We also did get some fiscal stimulus, right? We had the CHIPS Act, we had the infrastructure bill, we had the Inflation Reduction Act that, you know, that was a positive for growth in 2023. And I think that's a reason why we saw that pickup in growth in the second half of 2023. So to some extent that, you know, mitigated the impact of the contractionary monetary policy.
I kind of like the we got lucky theory. But I would have pointed to a couple of other things that were lucky, kind of lucky. I guess so lucky that I mean, in the sense that we didn't predict them, like the immigration surge, right? You saw a surge in immigration, like no one thought we were going to get 3.3 million immigrants last year. And that cooled things off in the labor market and allowed the Fed to, I mean, the funds rate might not have ended at 5.5%. It might have ended at 6.5% without the immigration surge, right? And that probably would have pushed us into recession. Or the other is oil prices, right? I mean, oil prices, they didn't go up when you certainly would have thought, given the sanctions on Russian oil and Saudi production cutbacks and OPEC, that would have happened. But who would have thought that North American frackers could push up production of oil by over 1 million barrels a day in 1 year and wash out the loss of production by Russia and Saudi and keep the oil prices down? That feels, I don't know if that's lucky, but that's hard to, you could not have expected. That's impossible to imagine. But here's the other thing, and Gus, because you know you're at a bank. My kind of pet theory, and by the way, Marissa, I agree with you on the quantitative easing. That's got to be part of the story.
Yeah.
I don't know how big a part, but it's got to be part of the story. There was no other period historically where the Fed was quantitative easing. This is the first time they were quantitative easing, and you know, when the curve inverted. Is that banks, PNC, did a very good job managing their net interest margins in the context of that inverted curve. So the curve inverts, net interest margins, the difference between what banks borrow, the rate they borrow on and what they lend at, that net interest margins, that's their profit margin, typically narrows and may go to zero, may even go negative historically. You can't make money, you don't make loans, no credit. And that actually is a real problem if it comes after a period of very rapid credit growth, because businesses and households need the credit, they need to refinance, they need to roll over their debt, and they can't do it, or they have to do it at a much higher rate, and that becomes very difficult for them to do. But this go around, banks did a good job of kind of matching and hedging. The net interest margins have held up a lot better than you would have thought. They're coming in now, but they held up for a lot longer. Therefore, credit continued to flow. And the other important thing is we never saw the kind of crazy lending, surge in lending, the rapid credit growth prior to the slowdown. And therefore, you didn't have a lot of businesses and households coming back to the banks and saying, hey, I need another loan. You got to refinance me you got to refinance and roll me over. And so those dynamics in the banking system, very different this go around than historically has been the case. Therefore, the curve as a signal has not been as useful. What do you think? Is that a theory you've not? Is that the first time you've heard that theory?
No.
Damn! Because I was going to take credit for it. I was going to say
no. I think that's the first time I've heard it articulated that coherently and kind of.
Oh, okay. I'll take that. I'll take that.
I've heard the pieces, but I think that's the first time I've heard it put together like that. And let me preface this by saying that I'm not supposed to talk about PNC specific stuff. So when I what I'm saying now is about the banking system in particular.
Right.
But I do think that the banking system has held up very well. I do think that banks have been responsible, much more responsible in extending credit during this cycle than they were, 15, 20 years ago. Some of that is banks learning from what happened during the financial crisis. Some of it is the regulatory system that's been put into place. I mean, you think back to 2021, and the biggest problem is that banks had too many deposits, right? That banks were flush with cash. But I think that they have generally been responsible about that. And we saw banks actually trying to move away from holding deposits, which is, kind of a new situation. And so I think that there is some merit to that theory. And you look at delinquency rates and, they're up a little bit, but they're still very low. You look at balance sheets, they're still pretty good. So I think that there is some merit to that theory.
Great. I'll take that. Well, let's move on to monetary policy, the Fed. What do you think? I think the widespread consensus now, I'm looking at federal funds futures for federal funds, the rate the Fed controls, is putting, I think, correct me if I'm wrong, Chris, I think it's almost like 100% probability of a 25 basis point, quarter point cut in the funds rate at the September meeting. That would be the first cut. And then pretty steady cuts after that, roughly a quarter point each quarter going forward. So by the end of 2025, the federal funds rate target, which is now just south of 5.5%, will be what, closer to 3.5, 3.75, something like that. I'm making that up, but that's roughly right. Gus, is that consistent with your thinking? Are you in line with the consensus?
Yeah, no, that sounds about right. We have the first rate coming at the September meeting, and then hold off in November, and then cut in December, and roughly every other meeting in 2025. So I think that that's, fairly close to where the consensus is. We've talked about the progress that the Fed has made. I agree with Marissa that they are, when they look at the dual mandate, that they're there on the maximum employment portion. I think that Powell has made it clear that he does not need to see inflation at 2%, to cut the Fed funds rate. The monetary policy will still be contractionary. It will still be weighing on growth, and they don't want to be behind the curve. They don't want to. Their view is that if they wait till inflation gets to 2%, then it's going to be too late, and that increases the probability of recession. So I think a rate cut in September, one in December, and then roughly every other meeting in 2025. To me, that sounds about right. And I think that hopefully should get us to that point where we get inflation back to that 2% objective by, mid 2025.
Good news. We got Marissa. Marissa, you're there. Congratulations. You made it through.
Thank you.
Yeah.
Good to be here.
And you look no worse for the wear, I must say. Yeah.
Thanks.
I think you're headed on vacation, aren't you, after all this?
I am. Yeah.
Yeah.
I'm going up to drink wine in the Central Coast of California.
That sounds like a lot of fun.
I mean, it's like 110 degrees up there.
Oh.
So drinking a full-bodied red right now doesn't really sound that great.
Well, take your swimsuit, jump in the ocean.
It'll be nice. Yeah.
you'll
Staying
be
by the
fine.
ocean. So
Saved by the ocean. Yeah.
yeah.
Well, it's good to see you.
Yes.
So back to monetary policy and the Fed. So that's what the Fed will do.
Mm-hmm.
Is that consistent with what you think the Fed should do?
I think so. I think that I think that I think the risks right now are weighted more towards weak growth than they are towards higher inflation. But I think that if the Fed's cutting every other meeting, monetary policy is getting slightly less contractionary. I think that this gives them the ability to cut more rapidly if they do see that the labor market is devolving. And so I'm comfortable with this. I think when the last dot plot, the summary of economic projections that the Fed puts out, I was a little surprised that they had inflation staying roughly where it was through the end of this year, and then only that one rate cut. Because I do think that inflation is moving in the right direction. And I think that the Fed should be cutting because monetary policy is still pretty contractionary right now. And that if they, if they wait too long, then we could get that potential recession because monetary policy is, rates are too high for too long.
So our forecast is the same. We're with consensus on September, a quarter point each quarter. One of the there's two debates in my mind that I'd like to get your sense of, and also from Marissa and Chris. One is what do you think the so-called equilibrium rate is? The equilibrium rate, so-called R star, that rate, that federal funds rate, which is neither a restraint or a source of support for economic growth. It's neutral with respect to growth, which presumably is where the Fed is headed here. They're going to start cutting rate 5.5%, where the funds rate today is, as you just said, you used the word contractionary, I would say restrictive. So that means that that's higher than the equilibrium rate. And presumably the Fed's going to start cutting rates and ultimately have the federal funds rate settle in at its equilibrium rate. What is that equilibrium rate today, and where are we going to settle?
You know, I'm saying this with no degree of certainty, but I do think it's higher now than it was pre-pandemic. So I would say somewhere probably around 3.25%. You know, you mentioned the immigration surge that we had earlier, which means that growth may be a little bit stronger over the long run than we thought previously. And we bumped up our potential growth rate up by about 1/4 percentage point. And so
is that right? Can I ask to what? Are you at 2.25 now, or what are you?
We're at about 2.1.
2.1. Okay.
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 So, so I do
growth.
think that there's, and we'll see if this immigration surge lasts. But I do think that there's higher potential long run growth. On the other hand, we're unsure what the productivity effects are going to be post pandemic, and so that would argue for a lower. I mean, the Fed funds rate being a little bit lower than that long run. So we'll have to see how things play out. But I'm saying this with no degree of confidence at all, right? I mean, we can't observe what the neutral rate is directly. We have to infer it. And then the other thing is that, certainly the fact that we have had growth that has been this strong, even with a Fed funds rate that is 5.25%, 5.5%, would argue that it might be a little bit higher now than it was pre-pandemic. But again, just no degree of certainty on that. I think we'll get a better sense during this upcoming loosening cycle to see how the economy responds.
Marissa, what do you think? What do you think the equilibrium rate is now? I mean, just again, for a little bit of context, if you go back a year or 2 or 3 ago, there's a wide view that the equilibrium rate, and this is consistent with what the Fed was showing in its forecast, that the equilibrium rate, federal funds rate target was 2.5%. Now there's a widespread consensus now it is higher. So the question to you is, and I asked that question to Gus, and Gus says 3.25 kind of feels right, with all the appropriate caveats here, low level of confidence, and it's a moving target. Totally agree with that. What do you think the equilibrium rate is now, and where is it headed?
I'm with Gus. I mean,
Gus.
we don't know, but I think it's somewhere between 3.5 and 4. I think that the economy, as Gus pointed out, I mean, it's been incredibly resilient to the rates that we've observed now for the past 2 years, right? I mean, we have a job market that is creating well over 200,000 jobs a month, which prior to the pandemic, that would have been a stellar jobs report, and we're getting that every single month, with a slightly higher unemployment rate over the past year too, which suggests that underlying growth in the job market is much higher than it was prior to the pandemic. So things have certainly seem to have changed. Now, whether these are permanent changes that we should expect for the next, 10 or 15 years, or this is something that is going to go away in a couple of years, that's what I'm unsure of. But I think as of right now, the equilibrium rate has to be somewhere around 3.5%,
Chris, you have
or even higher.
Yeah, the number in my mind is closer to 3.
Right now, closer to 3.
Yeah, that in terms of an equilibrium, right? It's going to take us a while to get there, but
right.
Yeah, I guess it's how you weight these various factors,
Yeah.
and there's definitely enough uncertainty from policy, from demographics, from productivity gains to
right
kind of make it very unclear. It's clearly going down from here, but it's going to be higher than it was prior.
Why will it go down from here?
Well, I think right now we're quite restrictive.
Why is the equilibrium rate going to fall though?
Oh, I'm sorry. I
You mean
meant
the
Fed
actual
funds
rate,
rate. The actual funds rate
Oh,
is
yeah,
going to fall
right.
down from
Okay.
here.
Yeah.
Right. The equilibrium is likely higher than it was prior to the pandemic for the reasons mentioned, but then it's a question of, again, how durable are some of those policies and behavioral shifts.
Yeah. My view is that the equilibrium rate's higher, and I'm with you, Gus. I don't say this with a lot of confidence, but it's much higher than it was, earlier in the pandemic, certainly pre-pandemic. I'd put it at 4. And the reason is that the economy is much less rate sensitive than it has been in the past. And it's very idiosyncratic. It goes to the fact that households, homeowners have been able to lock in, very low interest rates. Everyone got a mortgage when rates were low or refinanced down into a mortgage with a rate that was very low. I think the average coupon on an existing mortgage is still about 3.5%, and they're locked in, 30-year fixed, maybe a 15-year fixed. So they're very rate insensitive. This run up in rates has not added to household debt burdens or in aggregate, the household debt service burdens. And I think businesses also did a marvelous job of mostly locking in. Not everyone. There's, distribution here across companies, but I think on average, we've seen businesses do a very good job. In fact, if you look at net interest payments by non-financial corporations, it hasn't even started to rise. It has fell sharply, and it has not even begun to rise. If you believe the Bureau of Economic Analysis data, the BEA data. So if you're less rate sensitive, then that would require a higher equilibrium rate to get the kind of growth that is necessary to get inflation back, down to target. Now, if that theory is correct, that would argue that over time we are going to see the equilibrium rate come down, right? Because these liabilities that households have in the corporate debt, it's going to adjust, and it's going to adjust at a higher rate, and things will start to normalize. And so I do expect the equilibrium rate to come back in. And we have the equilibrium rate settling in at around 3%. So we're at 4. We were at 2.5. We now are at 4. We have it settling in at 3, which is still above the 2.5. And that goes to your point, Gus. And that is, I think the underlying growth rates of the economy are going to be a bit elevated here, in part because of immigration, although that's going to pull back here, I think, post-election. I think whoever wins is going to really clamp down on immigration. Obviously, Trump if he's president, is going to clamp down even more. But regardless, we're going to see that. But I do think we'll see somewhat better productivity gains going forward. But that's a whole different discussion. Yeah, that's a whole different discussion. How do you react to what I just said? Or is that...
Well, I mean, my question is productivity growth cuts both ways, right, though? Because that means we can have stronger output growth with lower inflation. And that might argue for a lower downward pressure on the equilibrium rate, I think. So I'm not convinced that stronger productivity growth necessarily translates into a higher equilibrium Fed funds rate.
Yeah. Okay. Fair enough. Oh, the other thing I wanted to ask about is the 2% inflation target. So, the Fed it feels like it's willing to sacrifice the economy to an altar of 2%, because, they're targeting the consumer expenditure deflator, the so-called PCE deflator that you called out, and it's 2% on the consumer expenditure deflator, and we're at 2.6%. And the only reason why we're not even below 2 on a consistent basis is the implicit cost of home ownership, the owner's equivalent rent. You exclude OER, owner's equivalent rent, and the implicit cost of home ownership, like every other country on the planet, most every other country on the planet does, because it's very difficult to measure, appropriately. And particularly now in the current context, when the housing market is upside down with affordable housing shortages and interest rate lock and everything else, you look at that, the consumer expenditure deflator, excluding OER, owner's equivalent rent, has been below 2% for almost a year, almost on a year-over-year basis, So by that measure, we're there. So with all of that, what do you think? Is 2% the right number?
So what I think the Fed is going to do is they're going to wait till we get to 2% year over year on the PCE, the core PCE, and then they're going to commission a working group to look at whether that is what the objective should be. And they're going to look at the post-pandemic experience. They're going to look at what's happened overseas. And I think what we're likely to see is, they could say, okay, we're not going to say 2%. We're going to say a range between 2% or 2.5%. Or they could move to some other measure, the harmonized one that they use in the EU or something like that, that excludes.
That's excluding owner's. That's what I'm saying. The excluding owner's equivalent rent, right?
And I think that there are good reasons for that. But I think the first thing that they need to do is they need to get to that 2% objective, so they can't be accused of moving the goalposts, because that ruins that hits their credibility the next time this happens, and people will say, oh, well, you got to 2.5%, and then you said that was good enough. And so the next time people are going to think, oh, well, if inflation gets up to 5%, then they'll just, get it back down to 3%. So I think they need to achieve 2% first. Then they'll look at this, say, what have we learned from this experience? Was this the right number? Should we, how can we reevaluate? And then I don't know what the answer is going to be. I don't want to prejudge that process, but I certainly think that we could come out of this with a different, we could have a range instead of a straight number. We could have a slightly higher number. We could have a different concept of inflation, but I think they want to get to that 2% objective before they start that process.
Okay, so that makes all perfect sense to me, and I think you're dead on, exactly right. But what's the number? Should it? I mean, if I had to pick a number, would it be 2?
I think
2.5.
2
would it be 3?
I think 2 is fine. Could I go to 2.25? Yeah, I could go to 2.25. I think it should be the harmonized with excluding the OER. For the reasons that you mentioned, it's difficult to measure. It doesn't really, it doesn't affect if you already own your home, it doesn't affect your housing costs. And so I think that, something like 2 or 2.25 on a harmonized measure to me sounds good. And I think, that means, and again, they want to be at the point where, I forget, that where I've read this, but, they want to be at a point where people aren't thinking about inflation. And I think if you're at 2% or 2.25% inflation, excluding OER, then I think, you can go about your day. You're not thinking about inflation. You're not thinking about prices. And that's good for long run economic stability.
Yeah. Okay. I put it at 3, because why? Because lots of reasons. I'll give you one. If it's 3, and then say your real growth is 2, you say 2.1, but let's say 2. That means your nominal growth is 5. And in historically in recessions, the Fed cuts rates by 500 basis points. So if it's at 2, there's a reasonably good probability that in a typical recession, the Fed's going to hit the zero lower bound on the funds rate and has to quantitative ease. And I don't think that's where they want to be, QE, for lots of reasons. So it feels like they should set the inflation target higher so that they can set the federal funds rate, the equilibrium nominal federal funds rate target higher, so that they don't hit that zero lower bound on a regular basis. That's kind of the thought process. My thought.
Okay, no, I like that argument. I'm not sure I'm 100% convinced of it, but it's internally consistent.
I'll work on you. Don't worry. Let's have a conversation.
Merit to it, so I'll think about it.
Okay. Hey, let's play the game, because I want to. We've already had a nice conversation here, but I don't want to lose you. I know you're going to go see the Phillies win against the Pirates, but and I do want to talk about fiscal policy and what's going on with the election and what that might mean. But let's play the game. The stats game is we each put forward a stat. The rest of the group tries to figure that out with cues and deductive reasoning, clues. And the best stat is one that's not so easy, we get it immediately. One that's not so hard, we never get it.
Mm-hmm.
If it's apropos to the topic at hand, all the better, or the recent data. So, and it's tradition around here, Gus. We always begin with Marissa. Marissa, what's your stat?
My stat is 20,000.
20,000 what, Marissa?
That is the question mark.
Votes?
What's that, Chris?
Is it votes?
No.
Votes. 20,000 votes.
Yeah.
Oh, that's going to be the margin of
A
victory for
margin
the
of
next
error.
president.
20,000.
No.
It's not anchovies. No. Okay. It's not widgets.
No, it's not anchovies.
It's not jobs.
No.
No. 20,000. Is it a statistic that came out this week?
Yep.
Oh, it is. Okay. I'm just thinking of all the statistics that came out. Is it housing related?
No.
Is it unemployment insurance related?
Yes.
Ooh.
Okay, that.
Oh, okay. So, all right.
An increase.
Oh, it was up 20K in the
Yes.
week.
Yes.
Okay.
Yeah,
Okay.
jobless. So initial filings for unemployment insurance rose 20,000 in the week ending July 13th. So they've popped up quite a bit. They're at 243,000 a week. The 4-week moving average is a bit lower. It's like 235. We saw this phenomenon happen last summer too,
Yeah.
in the middle of June and July, where unemployment insurance claims rose. And actually they were higher, significantly higher last summer than they are at this point right now. So kind of holding my breath that maybe this is just some new seasonal pattern that's emerging. But I picked it for two reasons. One is that I was kind of uninspired by all the other statistics that came out this week. And, I love the labor market.
It was a tough week. It was a tough week.
Yeah. And because I think it highlights some of the risk that we're talking about with the Fed keeping short-term rates high for a significantly long time, that it looks like the job market is slowing. We've seen the unemployment rate rise by 0.5 percentage point over the last year. Unemployment insurance claims are higher. That might be a false signal, but we've also seen, job openings, hires, quits, all come way in from where they were. So at this point, I think for the Fed, the risk is that the job market really starts to crater before they can start lowering
That's
rates.
a strong word, crater.
Yeah.
Boy.
I know.
But I mean, we did have.
But you're the one who said we soft landed. What the heck? I mean,
We did, but I mean, how long? How much of a runway?
Soft landing in the same
how
podcast.
Much of a runway do we give this? I mean, yes, there will be a recession at some point again.
Okay.
100% certainty. So how long do we wait before we?
Yeah.
Connect this right to the last business cycle. But I mean, to your point, with rates elevated and the Fed not cutting yet, I do think it's difficult to completely declare victory on this, and things can still go wrong. So
because I interrupted you. You were going to say
no. I think we did have some impact from Hurricane Beryl on the claims last week, correct? So that could be.
That's right. I didn't think of that. Yeah.
So I think if you look at the state data, some of it came from Texas. So it could be that's the impact there. So, and I like the fact that you pointed out the seasonal pattern. We saw the same thing last summer, and then they started to fall again in the second half of the year. So we'll see what happens on that score. So,
yeah, it's a good point. I hadn't thought about Burl. Okay, Gus, do you want to go next, or you want Chris to go?
Sure.
Okay.
So mine is 9.8%.
See, Marissa, he gives us the units. You see how that works?
Well, what was I supposed to say? 20,000 initial claims for unemployment insurance. Guess what it is?
Good point. Touche. 9.8%. Is it related to a statistic that has come out recently, Gus?
Not particularly, no.
Okay. Is it a growth rate?
No.
Is it a percent of some population?
Not really a population, no.
Okay. Is it inflation related?
No.
Jobs related?
No.
Housing related?
No.
Is it an interest
growth
rate?
related?
It in some respects it's housing related. Let's put it that way.
Is it an
in some
interest
respects.
rate?
What's that, Marissa?
Is it an interest rate?
No.
It's housing related. Single family housing related? Or multifamily?
More single family than multi, but it's not what you would consider a housing market indicator. Let's put it that way.
Right.
But housing drives a lot of it.
Right. Housing drives a lot of it. Of the 9.8%.
And it's not an inflation, shelter cost type. No. Okay.
No. You want to give us another hint? Can you give us a hint?
It's something that you had mentioned earlier in our discussion, Mark.
See, I have such a loud mouth. I
Oh,
mentioned
wow.
lots of things. That's the problem. Yeah,
It's
9.8.
is it a share of something?
Yes.
A
Usually how the percentages work. Right?
A share of something. 9.8% of people, households.
Is it construction related?
No.
Oh,
No.
Okay, we
All
got
right,
to
here, I'll give you a hint.
Okay.
please.
It's consumer related
Oh, it
or
is
household related.
household related.
Spending, saving,
You're close.
close, wealth.
But 9.8%, I can't. The saving rate is.
Something to do with mortgages and
Oh, is it the debt service burden?
You got it.
Oh,
yeah,
okay.
yeah.
Got it. Oh,
I kind of helped
ding,
you on
ding,
that
ding,
one.
ding, ding, ding. I'm going to take credit for that.
So I don't know. Everywhere I go, everybody's like, "Oh, consumer debt is at a record high," and
yeah.
they're all in a panic about this. And I say it's important to look at it in context. So
Right.
I think that does a good job of saying, look, it's still lower than it was before the pandemic, much lower than it was heading into the financial crisis. People have refinanced, and so they're still paying low rates on their mortgages, like we discussed. And so something that bears watching, but I'm not concerned about huge problems with consumer debt burdens right now.
The debt service burden, just for everyone out there, is the percent of after-tax income that it has to be devoted to servicing the debt to remain current on the debt. And Chris, you want to do a little bit of an advertisement? You and Scott Hoyt resurrected the financial obligations ratio, which is kind of like the debt service, right?
That's right.
Because the
That's
Fed
right,
stopped publishing. The FOR is a little bit different than debt service in that it includes rent. It includes now
leases.
Property taxes.
Well, they stopped.
owners.
The Fed stopped constructing it,
Yeah.
and so we took it on ourselves, and we've improved it. So, Chris, you want to quickly mention that?
That's right. You got it. So we added
Okay.
auto leases, property taxes, some of the other recurring expenses, insurance.
Any sign that that's rising? Any different than the debt service burden? Is it starting to show any signs of increasing?
At a very similar pace, right? So it is rising relative to the pandemic lows, right? But still very much in line with where it was in 2019. It's not really showing any warning signal.
But although, Gus, just to push back a little bit, you're looking at the aggregate, meaning across all households.
Yes.
And the folks at the top end and middle end are
absolutely.
fine. The guys in the bottom end who take on the credit card debt, the subprime auto, the consumer finance, I'm pretty sure their debt service burden is up, right? Because they don't have a mortgage locked in, and the credit card. I don't know if you look. I'm sure you look at credit card rates. They're at record highs. 22%, right? So, yeah. Okay. Okay, Chris, you want to go?
Sure. 656,000.
600
Housing related.
Yes.
Go ahead, Marcel. I'll let you
Please.
run with this.
It's new. It starts.
Nope.
Permits.
Nope.
Single family starts?
Nope.
It's something with units under construction, the number of completions.
Yes. What kind?
Okay.
What
But
kind?
it's not total complete. It's not total
Nope.
completions, because total completions is 1.7 million.
Very
So
good. Very good.
Yeah.
It's single family.
Multifamily.
Multifamily.
I'm just saying, guys, I'm like cleaning up at this game.
Okay,
No.
yes, but you are getting help.
What do you mean I'm getting help? You mean you're contributing to my thought process?
I
Yeah.
think so. I'd like to
Put
think
you on the
so.
right road.
All right, yeah, fair enough. I got it. All right, that's a good one. You want to explain why you picked it?
I picked it. Well, the other permits starts they're weaker than they were last year. I think there too, there's some hysteria that the whole construction industry is falling apart. It's certainly weaker than it was a year ago, but it's kind of on par with where it was prior to the pandemic in terms of single family, multifamily starts and permits. But completions continue to rise, right? There's still a lot of projects in the pipeline, lots of construction activity still going on. So we're still building houses and we're still putting up a lot of multifamily apartment buildings. And in terms of the inflation outlook we talked about earlier, I think that's important. It's going to continue to keep a lid on some of the rent costs or the owner's equivalent rent that we talked about earlier. So I'm less concerned about that taking off again, kind of disrupting the Fed's plans for a rate cut. So I view this as positive news.
Very good. All right, I got a statistic. It might be a little controversial, and I just preface this by saying, guys, we can edit if you want to.
Oh boy.
We can edit.
All right, that must
and
mean
if
it's
we don't
banking
edit, this
related.
will be a good thing to keep in the podcast. But
Okay.
and podcaster listeners, we rarely edit. We only edit when Chris messes up, which isn't very often. When he starts bragging about his crypto portfolio, we tend to, edit that out. And when he brags that he's like the world champion in bocce ball, we cut that out generally. But here's my stat with that as a preface. $175.51.
The share price of PNC.
Oh
my God.
That's unbelievable. How do you know that? Come on.
You kind of gave it away. Come on.
Oh, did I get it? Oh, no. That was unbelievable. Oh, really? Gus, did you know that?
I did actually, yeah.
Oh, you did?
Probably to the cent, right?
No, wait. Someone told me the Moody share stock price. I could round to it, but I don't. You guys look every day? No. That's pretty cool. But I just picked that because that, it just shows the strength, because PNC is a large regional bank.
I will put in a plug for PNC. We're now coast to coast. We're in all 30 of the largest metro areas. We completed a merger with the U.S. operations of BBVA a couple of years ago. That was a big expansion for us. So I think it's fair to say that, we're not at the top of the list, but we consider ourselves now a national bank.
Yeah. Okay. Fair enough.
What size are you?
I didn't mean to. I was going to say nice. I love PNC Bank. And I actually could tell you a great story about yesterday. My daughter lost her debit card, and great ending, and so forth and so on. I just use it as a kind of a benchmark for the broader banking system. And it just shows it feels like the system's back, right? I mean, because if you go back in the teeth of the banking crisis a little over a year ago, the share price was, I think, got as low as $120, $115 a share. So it made a long way back.
That sounds about right. Yeah.
Yeah. So, and that's really key, because I do think because the curve is still inverted, one of the reasons to be still a little bit nervous is with the Fed keeping rates as high as they are for so long, and the yield curve being inverted, that continues to put pressure on the banking system writ large. And that is a potential risk to the soft landing scenario. So, but right now, the system feels like it's in a pretty good spot, kind of navigated the crisis admirably well with a little bit of help from the Fed. And here we are. So a good one. That was great, Chris. You did a great job. That was really, really good. Okay. Let's move forward and let's talk about the election a bit. And let me frame it this way. You like us, Gus, you have a forecast. Mm-hmm. You have let's call it a baseline forecast, meaning kind of in the middle of the distribution of possible outcomes. So when someone says to you, what's your forecast? This is your forecast for the economy. And in the forecast, you have some assumptions, whether implicit or explicit, with regard to the conduct of policy. We just talked about monetary policy and what the Fed's going to do, but also about fiscal policy. I mean, that's important. Tax policy, particularly looking forward, because we've got the tax cuts to individuals that were passed under former President Trump, like the TCJA, the Tax Cut and Jobs Act. They're expiring at the end of next year, and how what you think about that will determine a lot about what you think about the economic outlook in the near term. So therefore, you have to have some view about the election outcome. And just again, to before I hand it over to you, say that in our baseline forecast, we have been assuming basically the status quo, which means Biden remains president, or I should say, to be more careful about that, the Democratic candidate for president becomes president, because obviously that's a question at the current time. but that the Congress is split, that the Senate, which is now Democrat, goes Republican, and the House, which is Republican, goes Democrat, but it's split. So that means it's a divided government. You don't get much policy change, pretty much the status quo with a few exceptions. And that's the baseline. But that feels like a very tenuous election assumption at this point, right? I mean, it does feel like, Trump's going to be president. A lot of script to be written here, and things can change very quickly. But at the moment, it doesn't feel like that's like the most likely scenario. But I said a lot. I'm going to stop right there and turn it back to you and see how you think about this.
So ours is a little more generic. I mean, we're assuming that there's divided government in some form. So whether that is a Biden-Harris administration and Republicans in charge of one house of Congress, at least one house of Congress, or a Trump presidency and Democrats in control of one house of Congress. So I think I agree with you completely that I think the in terms of fiscal policy, status quo is most likely, and we do not have big changes particularly in federal fiscal policy. I do think that we may see a little bit of contractionary on the state and local side. I think that the property tax.
For a second, though, to your point about divided government, which is a reasonable point. You're saying it could be Trump as president and still a divided government, but you have to. But let me ask you this: what are you assuming about the tax cuts next year? Are they going to be fully extended for individuals, or are they going to be extended for people who make over 400K?
I think that they will probably be fully extended.
So that means Trump's going to be president.
Well,
I mean, doesn't it?
I guess. Well, let me put it. I think we're likely to see whatever ends up happening. The total fiscal impact will be roughly the same, whether it is a Democrat or Republican. Okay. So maybe the mix of cuts is different. Maybe some of it. You have some of the tax rates on higher income households reverting back at least some of the way, but that's offset with a spending increase. So I think the impact on the projected deficit is going to be the status quo. Whether it's exactly what the package is, we're not putting a stake on that.
Okay, fair enough. But now you were going to say something. I stopped you about.
Oh yeah, I think that on the state and local side, it's likely to be perhaps slightly contractionary in the near term, just because of the issues that many localities are dealing with in terms of property taxes, because of the ongoing problems with the office market. So I think that is going to show up in contractionary state and local policy, local in particular.
So would you agree with me that at the current point in time, the most likely scenario election outcome, and again, this is really important to what future fiscal policy is going to be and what it means for the economy, the most likely scenario is that Trump is going to be president and there's going to be a Republican sweep? I mean, that's certainly in betting markets, that's what they're saying.
I mean, I certainly think that, over the past month that probability has gone up. And I do think that has big implications for fiscal policy, and it means that fiscal policy is much more likely to be expansionary in 2025, 2026. I'm not ready to put that in the forecast yet, but we'll see how things progress over the next few months. But I think that the likelihood of that happening has gone up dramatically over the past month.
Okay, and we're in the same situation you are, right? So, again, we assumed Biden divided government because we have a very explicit assumption about the taxes are going to be extended only for people who make over 400K.
I'm sorry, when you say extended, you mean the taxes, it's going to revert back to the previous level for people who make more than 400K?
I'm sorry, for people who are under 400K, they maintain the current tax rate.
Okay, under 400K.
Under 400K, I don't know what I said. If it's over 400K, your tax rate goes up.
Okay, yep.
Right, that's the proposal that's the Biden-Harris has been running on, and that's our explicit. But right now it looks like a Trump sweep, and the question is, at what point what is the catalyst for making a change here in your baseline forecast? Do you actually wait all the way to the election to see how it plays out, or do you make a change before then? I mean,
I
what
think
is
we would-
what is the I guess I'm asking a philosophical question. What's the forecast philosophy with regard to this is a major change? I think
Yeah.
you would agree in assumptions. At what point do you make that change?
I think, and I don't want to, preclude changing my mind on this, but our view would be that we would
Yeah.
wait until after the election,
After the election.
and we know what the outcome is, and we, see what the, get at least an indication of what the proposals are going to be. So
Okay.
we're talking, May, November, December, let's say.
No, okay, November, December. Okay. I feel, what do you guys think? Does that sound right to you, Chris and Marissa? I mean, in terms of the way we approach it, I mean, just I'll preface it by saying our philosophy has been we don't make any major changes to the underlying assumptions, whatever they may be, in the forecast unless we're highly confident in that change. And the kind of the rule of thumb for the level of confidence is a 2/3 probability. So if I thought there was we thought collectively there was a 2/3 probability that it's going to be a Republican sweep, at that point we would make the change in our assumptions in our baseline. Now, it does feel like, given how uncertain everything is here, at least at the current point in time, there's no way you can be that confident in any of this. Therefore, we're not changing our underlying assumption. And it feels like we're not going to be there until we're on the other side of the election. But it could be the case. It could be the case that, at some point here in the not too distant future, we do feel confident and we'll make that change. Chris, did I get that? Did you get that right? Is that okay? All right.
And I agree with you. I don't think that we're going to be I don't think the level of certainty is going to reach that threshold before it actually happens. So
Right.
I think, the Gus philosophy of we just keep it because it's so close to 50-50 that then we just see what happens after the election and change the forecast after the election. I mean, that seems like the way it will play out for us as well.
Yeah. Okay. Okay,
And
guys.
Victory also.
Sorry.
Okay.
Go ahead, guys.
Sorry, and part of it too is it's like a 0-1 outcome, right? I mean, it's not like there are gradations that are in
Right.
between it.
Yeah,
So
right.
if you get it wrong, then you have to go back
Yeah.
and redo
Yeah,
all those changes.
Exactly.
And so I think under those circumstances, it makes more sense to just wait until you have an answer.
Yeah, I think that makes sense. Well, let me just to play it out because
So I'm sorry, Chris, were you?
oh, sorry.
Sorry to interrupt. Chris?
I guess a little pushback. I was about to say that I think the margin of victory does matter. That if it's might be a Republican sweep, but it's very close. I don't know in terms of what the exact policy will look like.
Really?
Going to
You think
next
so?
year.
I
think
don't
you still
know.
have.
If he
I
wins
still
by
think-
if it's a Republican sweep by one vote, the whole world did 0-1. I think. You don't think so?
I think that the negotiations may be much more fraught at that point. I mean, you still have some variation in terms of fiscal hawks versus not.
Yeah,
I think
true.
you could see some variation in terms of what the actual policies look like.
I mean, the scenario could very well be the Democrat wins the popular vote, like they've done in the last couple elections, and you still have a Republican sweep. Still, then what do you do with that? I mean, still interesting question. But let's because we're running out of time, let's go to the Republican sweep scenario because that does feel like a real possibility. How would you Gus? How would you characterize policy under a Republican sweep? And here I'm thinking tariffs, I'm thinking immigration, I'm thinking Inflation Reduction Act, I'm thinking fiscal policy, tax policy, spending policy, I'm thinking regulation. But pick whatever you think is most appropriate. But where are the biggest changes going to be, do you think? And what does it mean for the macroeconomy?
So I think it is generally more inflationary. I think you get more expansionary fiscal policy. I think that the emphasis is going to be on tax cuts and not. I think former President Trump has shown less interest in containing spending. You're running on a populist platform that presumably precludes big cuts to Social Security or Medicare or to defense, which are really, that's where the money is in the budget. You get, tax cuts, talking about reducing the corporate tax rate, for example. And then I think that generally tariffs are inflationary, that, we get those, to what extent that's actually, we get those tariffs, I don't know. But I think that means that at least in the near term, it's inflationary. And maybe we see the Fed pushing back against that. But I think that a Trump administration is a more inflationary fiscal policy than we would see under a Democratic administration.
Not to put words in your mouth. So you're saying more inflation because tariffs, deficit finance, tax cuts. You didn't mention immigration, but
well, I think immigration, we've talked about how that's been a source of labor force growth. I think that's severely restricted. And so that means weaker labor force growth. So I think in terms of the growth impact, I think, I think it's roughly neutral for growth, probably, because you have slower labor force growth. You have tariffs, which would weigh on consumer spending growth. You have stronger fiscal support, and then more contractionary monetary policy. So I think on the growth aspect is roughly neutral.
Okay, so more inflation, higher interest rates, but that doesn't result in weaker growth. You end up in the same place on growth. Okay.
Mm-hmm.
Okay. Well, what do you think, Chris, Marissa? Anything to say on this? I mean, we've run a lot of scenarios. We'll continue to run scenarios. I mean, we are updating the scenario, the Republican sweep scenario, because we've previously run this and we assumed tariffs, but we did assume no retaliation from other countries because we weren't. That was felt like it was pretty tough to do, but now we're updating that scenario because we have economists all over the world and they're coming back with, well, what would the governments of these countries do if they did face 10% tariffs from the United States? And we're running that through the model as well, and we're going to produce those scenarios. But anything else you guys want to add on this subject before we call it a podcast, Marissa?
No, I mean, I think the results of that will be interesting because I would expect even more global inflation, right? If there are retaliatory tariffs from other countries that we haven't already factored in, and
slower
possibly
growth.
slower growth, right? Slower
Right.
global growth.
I think that's where we depart from you, Gus.
Okay.
I mean, I think definitely inflation and therefore higher rates. And if you want to get inflation back down, you got to have slower growth, less demand. So I think that's where we would part. But anyway, sorry, Marissa, I interrupted.
Nope, that was it.
Okay. Chris, anything on that?
Yeah, just to add, I think the dynamic response here is going to be really important, really complicated, right? So you go down this path, and if there's a violent market reaction, right, to the tariffs, they're going to backtrack, right? They're going to make some changes here. So, you got to take a stand in terms of the scenario, but I think the uncertainty is pretty wide on this one.
Yeah, very uncertain. And I guess I'll end by saying Pennsylvania, Gus, like we're like the key state, aren't we? And all that
we are. And in fact, I was, speaking to the Pennsylvania State Mayors Association yesterday about the Pennsylvania economic outlook. And, I mean, we're a heavily divided state, and we're a slow growth state. I mean, we have an older population. We've seen weaker economic growth. Some parts of the state still haven't seen a full recovery in employment from before the pandemic. So it's an economically diverse state too, is right, because you have a lot of financial services and professional services in Philadelphia and Pittsburgh. You have a lot of heavy manufacturing in the central part of the state. In up in Erie, you've got retirees in South Central Pennsylvania. So it's a very broad demographic economic mix. And I think it's going to be interesting to see how the various messages play out in Pennsylvania over the next few months. So I don't like seeing all the ads when I watch TV, but I think that's going to be par for the course for the next 3 months.
Well, I know you travel the state quite extensively, and the state is very bluish in Pittsburgh and Philly, and then deep red everywhere else. I think there was, I think it was someone said, Pittsburgh and Philly and Mississippi in between or something.
Right. Pennsylvania. Yeah.
Someone said that. So do you have a red tie and a blue tie, Gus, when you go visit these areas?
I try
Purple
to
tie.
keep it. I try to keep it neutral. I mean, I speak.
So you have a purple tie. You wear a purple tie to everything, all your events.
Yes. Actually, I do have a PNC tie that has the blue and the orange on it. So I kind of sometimes I go with that. I try to put on my neutral hat and talk about what the potential implications are, like we've been discussing, but I try not to bring my own political biases into this. So.
Yes, very good. Very good. As a good economist should. Gus, thank you so much for spending your Saturday morning with us. I know that was a bit painful, and the conversation was great. Really appreciate it. So thank you.
All right. Thank you, Mark, Chris, Marissa. It's been fantastic catching up with everybody, and thanks for having me on.
Hey, Chris, Marissa, anything else?
Yes, thank you.
Marissa, don't turn off your PC. I'm just telling you, don't do it. Don't do it. Don't do it. Okay, with that, dear listener, we're going to call this a podcast. We'll talk to you next week. Take care now.